that side of things, on the income side of things, right? The selling options. Collected that entire premium of 420. So that was against the full IBIT position, right? Very, very favorable. So it comes down. We see that option pricing compress. We see the stock pulling back a little bit, dropping below that strike price of 50. And we just kind of let it bake off, right? So initially you have just a bit of compression there, which we call Vega. So you get that nice big initial win. And then time takes over in terms of Decay and Theta and that sort of thing that you can't really rush. It just sort of takes time. So we get into that April expiry, and these things expire worthless. And then what do? Well, you have to take a look at the situation again, and you have to assess based on what the market is now presenting you. So we've collected this premium, which ends up being about 9% on underlying risk, right? You've collected 9% for about 41 days of work. Now that had a little intrinsic value. So if you just isolate the time value in there, which tends to be the kind of part that you focus on from an income standpoint, that ends up being 7.8%. That's 69% annualized. So nice trade. Now, I'm not saying you're going to do this all year long, but 69% annualized, very, very nice trade, which is one of the reasons we like to do income trades in the coin complex, is we do like those nice premiums that we're getting, but you have to do it with a sense that it isn't always the right thing to do, because there is that explosive upside. And that's why you're involved in this particular space to begin with, right? You don't want to give away performance if you don't have to. And that's really what we're talking about today. So if I can talk to you briefly about this, well, where is the edge, right? So we see that the call side tends to be a supply-driven part of the skew curve. So option pricing suffers on the call side a lot of the time, and we get that smaller volatility risk premium.